What is up, everybody? Good afternoon, good evening, good evening. It is actually after dark. So, hey, Pitch Mortgage Team here. We're Mortgage from a Treehouse, episode number 2 coming at you. We're talking about something really cool today. It's about discount points. One of the comments last week was, "Hey, what can we talk about that you want to dive deep into?" So we're going to focus for the next 15, 20 minutes about points and fees and all that good stuff that go into a mortgage, and kind of what's the opportunity cost? Should I buy down the rate? Should I do discount points? All that good stuff. So welcome to the show tonight. A little bit before we jump into rates and fees, let's talk about mortgage rates. Mortgage rates are moving up. Up is the trend, and this trend is going to continue up as far as I can see right now. Probably maybe getting closer to the 3.25 right in there, maybe a little higher. So the rate trend is definitely on the way up. The last 2 weeks have been kind of not so great for the mortgage industry as far as rates are concerned for you guys out there, but all in all, historically, again, if we look close, I'm going to go big here. If we look close, right down here, 1980s, the 1980s were huge. We're talking double-digit interest rates. So still to be in the threes, awesome time to buy, awesome time to be in buying a house, refinancing a house to buy another house, leveraging and grabbing some more. So great time. We're not in the twos anymore, but hey, you know what? Three is not bad either. So today, points and fees. This is a question that comes up almost every single transaction, whether you're buying, whether you're selling a house, or whether you're refinancing a house. This always comes up. Keith, should I buy down the rate? Should I incur some discount points with that? And I want to add this back to the screen and go to our presentation here. Points and fees. The question is, before we have that question answered, we have to ask one other question. How long are you going to be there, right? What's a discount point? A discount point is a point that you're going to prepay interest on the loan up front to get a lower interest rate for the life of the loan, right? So a discount point will help lower the monthly payment. It will help in that respect. It'll help on the interest paid over the life of the loan, but is it worth it? That's always the question. So in true fashion, let's look at an example, right? So this is an assumption only, right? It's a little bit acclimated here for the new rate environment going up to 3.25. So we're going to make some assumptions and go from there, kind of weigh out the options, so to speak, right? So let's just assume you're out there doing a $650,000 mortgage, whether that's a purchase, a refinance, whatever that looks like, it is what it is, right? So it's a $650,000 loan. You want a 30-year fixed, and you have a 720 credit score. So you have this really cool option, and chime in here if you knew this, but you as the consumer get to choose that rate. A lot of folks just come to me and they're like, they never know that there's discount points. They never know that there's rebate points. They're just never taught that they have control over the rate that they pay on their mortgage with respect to the market between discount and rebate points. So the financial markets set the tune of what a mortgage interest rate is going to be, right? So let's say today, and in this example, 3.25 is a par rate, right? A par rate means there's no discount, means there's no rebate, right? No credit back to you, the borrower, for doing the mortgage at that interest rate. So what you get to do as the consumer, always in the driver's seat, right? You guys get to, I'm going to make this a little bit bigger. You guys get to choose whether or not you want to take the par rate, the discount rate, or the rebate, right? And the rebate lowers your closing costs. So here in this illustration, right here, the 3%, so 3.25 is the par rate. 3% is a 0.5 or a 0.5% discount, which would add to your closing costs. It would add $3,250, right? So just as going lower gives you a discount and it adds to your closing costs, if you want to go higher in interest rate, and people may be looking like, Keith, what are you doing going higher in interest rate? Why would you do that? You'd want to lock that rate in as low as possible and go deep, deep, deep. There's reasons. So you could take a higher interest rate. And let's say for this example, we said, okay, 3.5. 3.5 is actually going to be a rebate, a credit back to you of $3,250 off your closing costs. Mind blown, right? A lot of people are like, wait a second. I could take a little bit higher interest rate and you give me money towards my closing costs, so I don't have to put as much money into the transaction. Yep, that's exactly how that works. So just as you can go out there and buy discount points, you can go up there and take a little bit higher interest rate and cover your closing costs, right? Now, people may be asking me, well, why would you want to do that? It's a great question, right? We talked about the opportunity costs, maybe less money into the transaction. You can keep it vested in a retirement account. You can keep it vested in another investment vehicle. Maybe that's an opportunity. Maybe we just don't have a lot of funds available to close on a purchase, or we're short funds to close on a refinance. And instead of not closing that transaction at all, now you have options, right? So the cool thing, and this will always be an underlying tone in all of these mortgage talks, is guess what? You have lots of options in what you can do with your mortgages and how that looks. So let's fast forward to our next slide tonight, and let's go ahead and click that. In true mortgage from a treehouse fashion, I prepared a mortgage illustration, right? So we looked at mortgage illustrations last week about the difference of the opportunity cost between putting small down payments and large down payments. And now let's go take a look at what this really looks like as far as discount points versus rebate and credit toward your closing costs. So I took that same example that we had and I put it into a mortgage coach. Let me throw this up here really quick. So if you want to go take a look at this mortgage coach and follow along with us, you absolutely can. So let me paste this in the chat right now. Boop. There it goes. So here we go. We got our three options, right? We've got 3% with a half discount. We've got 3.25 at par. Par rate is just another way to say no cost, no credit, right? And then we have 3.5, which is that 0.5 cost or credit that we were discussing. So let's look at the opportunity here. Again, $650,000 mortgage. The payment, right? The payment is different by about $90 per quarter point in interest, right? So 3% is $27.40. Then kick that up by about $90. Now we're up to $28.28. Oh, that's cool, $28.28. And then kick it up another quarter. We're now up to $29.18. So from the top side to the bottom side being the most expensive, you're saving $178 a month, right? So we totally get that. I'm going to make this a little bigger. I'm noticing that it's small. So, but the difference is basically a quarter is going to equate to $90 worth of monthly savings. So this goes back to that ever-evolving conversation and flexibility of mortgages to help you execute on your financial plan. What fits best, right? Here's another scenario that I come across a lot. I'll have clients that come to me and say, hey, Keith, guess what? I'm here and I'm not going to be in the area very long. I'm wanting to move back to family, but I want to own while I'm here, take advantage of interest rates, take advantage of appreciation, take advantage of just owning a house and not burning the money to a landlord somewhere. So they don't want to have a bunch of upfront costs, right? I'm going to be here for 3 years. Well, where's my break-even point? How much money would I save? Does it make sense to invest the money in discount points? So we can like we did last week, we could say, hey, what would this look like? Oh, well, here's our monthly payment difference. Well, I'm going to be here 5 years. Does it really make sense? Will I save enough money to cover that upfront discount point of $3,200, $3,250, right? So then we can benchmark this against each other and say, okay, hey, I'm only going to be here for 5 years. So should I buy the discount point? Does it make sense? Am I going to get my money back? And yes, in this case, it would, right? The delta between these two, from a par rate to the 3%, definitely going to get your money back. The flip side to this is, you're not saving much money on the 3.5, but closing costs, right? Let's talk about closing costs. Right here are the closing costs. Let me unhighlight this and make this a little cleaner. So here's closing costs, right? So this is full boat plus the $3,200. This is just the closing costs. We'll dive into the closing costs a little deeper. And then here's your closing costs with the credit. So now we're taking into account, well, what do I have liquid? What can I put into the transaction? These are all great questions to talk through and talk about with whoever's making the financial decision with you, as well as your mortgage advisors. You guys have so much more control over the transaction than you ever thought when it comes to interest rates and assets. So looking here, closing costs break down amongst the three, and you can see here the credit gives you a substantial difference between the cash to close. So a very interesting thing. I hate to sound redundant, but it really is about the best financial decision that fits your need. So moving right down through here, and then here's where the long-term view. Maybe this is your forever home. And this is where we really dive deep into this conversation about buying discount points, right? If this is your forever home and this is never, ever, ever going to change, and you want this to be your home, just keep in mind, I do want to throw this in. The average American has their mortgage for 7 years. After 7 years, they're refinancing or they're selling the house, right? So just keep that in mind when you look at long view. Long view, we all think that we're going to be there for 30 years. Very few people get there. In 22 years of doing mortgage, I've met one person, I've helped one person who's actually paid off their mortgage in full, right? The majority of people still transact in mortgages typically somewhere in that 7 to 8 year ballpark. So, but this is very interesting to look at. The difference over the whole 30-year term is roughly about $65,000, right? So you do save money over the life of the loan, and the longer you're in that loan, the more prudent buying points is. So it's definitely something about financial planning that you want to sit down and pencil out. How long are we going to be here? Is this my forever home? If it's not my forever home, this is just the get the kids through high school home, or this is just I've relocated and I need to find out a new area kind of a home loan. So there's lots of flexibility in it. So definitely ask those questions when you're in your mortgage consultation. They will pay off huge. So let me flip back here to our presentation. Once I find it. Right there. There we go. Perfect. So again, the biggest question, the important question alert that I have right now, the biggest question you always have to ask before you jump in the discount point bandwagon is how long you're going to be in the home. What's my intent? How long am I going to be here? The longer you're going to be there, like I just said, the better off you will be. So super important. So this got me thinking, if we're going to talk about discount points, if we're going to talk about all that good stuff, what goes into a mortgage as far as that is concerned between rates, rebates and discounts, let's talk about how you compare lenders with rates and discounts. And it's interesting because we have been trained by a lot of the information out there that we should all be jumping on the APR bandwagon, which is a good litmus test. But you want to definitely get into the other fees that are on the quotes that you're getting. So, whoops, click on the other. There we go. So comparing lender fees, the lender fees are their points that they're charging for the rates, right? I may be charging something completely different for the rate that we're offering today as opposed to another mortgage professional, right? So here's how the rates work, right? We all get, I'm going to pull this up, right? You can buy this JBL clip, little Bluetooth anywhere, right? You could go to Target, you could go to Fred Meyer, it's on the shelf, right? But it could be two different prices. The rate environment is just like that, along with the other lender fees, such as processing, underwriting, how much they charge for appraisals. So you want to get their fee sheets and kind of look at what the lenders are charging and what lender A is charging and then what lender B is charging, and kind of compare and contrast and figure out what really is going on there and where is the best place to put your mortgage going forward. This link right here will take you to the CFPB, and I wanted to really dive into this just a little bit more because one of the mortgage docs that you guys will see is called the loan estimate. And there's a lot of questions that happen with the loan estimate. So this is one way that people quote. I quote through Mortgage Coach and send you a mortgage illustration because I think it's a really dynamic thing. Some folks will just give you a static loan estimate or a fee sheet, one-page fee sheet, which will have lender fees and what have you. But I figured this would be a great time just to get you guys familiar with the loan documentation. I've shared a handful of two mortgage coaches with you thus far. So I wanted to also show you what the loan estimate looked like. And the loan estimate will have your applicant information up here. This is again from the CFPB's website. Let me make it a little bit bigger here. So the CFPB has got this great website. I will also put this in the chat for you guys so you can have this as a reference point. On the first page, it just gives you the snapshot overview. Like, hey, what's going on with this? So your information, what you're trying to do, it's a 30-year fix up here in the top right corner, 30-year fixed purchase, and it's a conventional, is it FHA, VA, tells you the loan type, and it tells you if your rate is locked or not, right? When you are shopping, your rate is not locked, and locking your interest rates are super, super important, especially right now because rates are trending up. So the quicker you make application with your lender and lock the loan, the better off you are. And to contextualize this, the mortgage rates have moved probably about 0.5%, if not 0.75% in the last 2 weeks. So we were talking mid 2s 2 weeks ago. Now we're talking low 3s today for the same exact scenario. So your lock can move, or your interest rate can move until you lock it in with the lender. That's when you can take a breath and say, good, I got my rate, it's locked in, I don't have to worry about it, I just have to close my mortgage by however long the lock period is, whether that's 30 days, 45 days, 60 days, 270 days, depending on your scenario that you're doing. But rates are subject to fluctuation until you lock the loan, so super important. Then in this first block here, this first third shows your loan amount, your interest rate, your monthly principal and interest payment here. Then it also denotes very specific terms of your loan. Does your loan have a prepayment penalty? Does your loan have a balloon payment? These are two things that were really fundamental as far as the change from the mortgage meltdown in 2007. So they want it full front and center, full disclosure right there in front of you. So then in the second third, you have what your projected payments will look like. Your principal and interest, does it have mortgage insurance? And are there estimated escrows that they're going to collect on your behalf? And as you can see here in the estimated escrows, it says, hey, yeah, we are collecting the escrows for taxes and homeowners insurance, and they are included in your mortgage payment. So this is all really good knowledge. And then at the very bottom gives you the brass tacks, the estimated cash to close between down payments if it's a purchase, and then closing costs, right? So that's what's in there is your total funds to close. So super, generic, but gives you the overview. And then the second page is where the money's at, right? It's where all the closing costs are at. So you want to take a look at, and this is where I'm talking about comparing loan fees. You want to compare the loan fees here in the origination charges, the services that you can shop for, and the service, or you cannot shop for, and the services you can shop for. So that's how the three of those come together and really boil down to your closing costs. That's where it's coming down. Now, I wanted to make a mention. Box A are the origination charges by the lender, right? So that's where you're going to see processing. That's where you're going to see underwriting fees. That's where you're going to see origination, discount points, all that good stuff. Services you cannot shop for. These are appraisal, credit reports. So these are reports associated with your mortgage that the mortgage company is going to go out and facilitate and get those reports back from you, right? These are pretty generic and pretty much across the board standard. These down here, services you can shop for. This is referring to our title and escrow service providers. And title and escrow service providers, they're pretty much in line with each other. However, they can vary from title and escrow company to title and escrow company. So in a purchase scenario, you're going to be locked into the one title and escrow company that is mutually agreed upon in your purchase and sale contract. So you're locked in that way. If you're doing a refinance, we can definitely ask you for a preferred title and escrow company, or we can shop that for you. I work with a handful of different title and escrow companies across all the states that I'm licensed in. So we definitely make sure that that's a tight fitting closing cost there. Now, these are the ones that are really in the control of the consumer on who you go with, which one you can do. Now, the right-hand side over here are the other costs, and these are called prepaid finance charges, right? So you're going to prepay 3 finance charges when you do your new mortgage, whether you're purchasing, whether you're refinancing. The only time you wouldn't be paying, you're always going to be paying some prepaid finance charge. And the number one that you'll always pay is the prepaid interest, right? So the prepaid interest on your loan is, let's take today as an example, right? Today is the 25th of February. Mortgages are a little weird with how they accrue interest. So since today is the 25th of February, there's 3 days left, right? So you're going to pay 3 days worth of interest on your loan at the closing table were you to close today. And what that does is then cleans up February. February's interest is all accounted for and paid, right? So then you won't have a mortgage payment come March 1st. Your first mortgage payment really is actually going to be April 1st, because here's how mortgages work. You have to accrue the interest on the mortgage and then pay for the interest that accrued, right? So you're going to accrue all the interest in March and then pay March's interest on April 1st. So that's why you prepay the rest of the interest in the month that you are closing, because you don't have a payment on March 1st where you would typically make that interest payment. So that's how that works. So you're always going to have prepaid interest in some way, shape, or form to be paid for. The other two are optional. Sometimes you do have taxes and insurance included in your mortgage. Sometimes you don't, right? So if you are one of those folks that chooses to have your mortgage include your homeowner's insurance and your property tax, then guess what? You got to build up those accounts. And in a purchase, you're going to prepay all of the homeowner's insurance for the upcoming year. So again, let's use today as a closing date. Today, February 25th, you close on your mortgage for your new house, and that's a purchase. It's beautiful. You love it. You're going to go move in. At the closing table, you're going to pay for February 21st or 25th, 2021, all the way to February 25th, 2022's homeowner's insurance. So the first annual premium for homeowner's insurance, check that box. That's going to get paid at the closing table. And then you're going to put a buffer of 2 months in there. So you're actually going to pay 14 months worth of homeowner's insurance at the closing table, because as you make your payments over the next year, and by the time we get back to February 25th, 2022, it's a lot of twos, you're going to have a whole annual premium set aside in your escrow account for your mortgage or from your mortgage company. So boom, we pay the homeowner's insurance. Same thing happens with the property and real estate taxes. We're going to impound based on when the next time the property taxes are due, right? So right now, again, if we close February 25th, 2021, the next taxes are due, guess when? May 1st, right? So you're actually going to prepay all the taxes between now and May 1st because your first mortgage payment is April. And then we're going to put 2 in a buffer so we have enough to make sure that we have plenty come October when the second half of the taxes are due. So prepaid finance charges, guess what? They're going to happen regardless of the lender you go with, right? A lot of folks, and I want to caution you here, a lot of folks see that one lender has maybe 3 months worth of reserves, one lender has 1 month reserves, one lender leaves the reserves off. And this is, I don't want to vent too much, but this is where other unethical mortgage professionals really skew the numbers. What they'll do is they'll have a quote and then they'll completely remove all the prepaid taxes and insurance. So it makes it look like their closing costs and it makes it look like their funds to close is less than the other lender. And if and only if you have the ability to waive your impounds for your taxes and insurance, is that acceptable, right? So definitely keep an eye out for that. If that is a deviation, see if one lender is withholding them, see if one lender is not, and make sure that you're comparing really what the lenders are charging as opposed to what it looks like as far as the bottom line and closing costs. So box A, super important. Box B, super important. Box E, F, and G, like, do they have them? If they do, great. Are they in the same ballpark? Awesome. But if one doesn't have any prepaid taxes or insurance and one does, then just kind of parse that one out and just look at the lender fees, because that's what will come through. And then the taxes are going to be up to you. Again, for those of you that have a sizable equity position in your house, you don't have to have the mortgage company collect your taxes and insurance. You could choose not to have us do that. So that's up to you guys. And then lastly, the third column here, or the third page on the loan estimate, it's where you're going to see the comparisons and then also about late payments and whether or not your loan is transferable and assumable. So definitely pretty good stuff here to know and be familiar with. So you're not like, oh, hey, what is this disclosure? When you see it, whether you're in the quoting process or whether you're actually in the middle of a transaction, you want to know at a high level what these all look like. So wanted to share those with you guys tonight, and make sure that if you have any questions that you let me know. I'm going to skip ahead here really quick, just a little bit. So let me bring back up the PowerPoint. There we go. So just in comparing here, again, lender fees, points, processing, underwriting, appraisal. We looked at the loan estimate. The loan estimate is in the link too. So feel free to check that out. Super fun. Third-party fees, title, escrow, and attorney fees, and then those prepaid items. Definitely check out those prepaid items to make sure that you're in the same ballpark and whether or not one left it off or not. Last but not least, I didn't look at seller credits. Seller credits, lender credits, and real estate credits. If you are transacting real estate, as far as a purchase and sale, sometimes you do have a concession. This is very common in new construction. It's very common in existing home sales, like in 2018. Right now, it's not hugely common that there's a lot of real estate credits or seller credits going on. But if they do, they are also disclosed both in fee sheets and on the loan estimate on the bottom right-hand side. So always good to check that out. And then lastly, I know we went long for our first episode. Lastly, I just wanted to talk to you really quick. What else can we learn about? What else can I bring to the show for you guys so you become more educated and empowered about mortgages? We're right here at a half an hour, which is right the sweet spot that I want to keep it at as far as engagement and not be too in-depth or not be too detailed about stuff. I would rather take 30 minutes on one small topic and get really deep into that topic as opposed to getting too wide, because then we can just grab it the next week. So if you do have any questions that are just burning inside, you're like, hey, how do I do this? How do I buy with no money? How do I, what documents do I need? That is going to be a great little pivot to next week's show. So next week's show, we are going to talk about, boom, documentation. Documentation is huge. It is sometimes stressful. It is the way that you get your loan done, because we want to document how you're going to pay the mortgage. We want to document where that money is coming from. We're going to dive deep into those of you that are self-employed, those of you that are 1099 commission people that write stuff off, and those of you that have complicated tax returns. Definitely join us next week so we can dive deep into those topics, because the more you know, the easier the transaction is. And it actually, dare I say it, mortgages can be fun, right? We just don't like surprises. Everybody says they like surprises, but they don't, especially in a financial transaction like a mortgage. So the more I can bring to you guys and the more I can empower you through education, the better. So let me know, drop me a line, share, like, and definitely subscribe to our YouTube channel. We appreciate you guys showing up tonight, and have a great evening, and we'll see you next Thursday.